chapter 13, we're looking at specifically costs, and costs are the same for every single industry that we're going to study. For most classes, this is our end, but it will be the beginning if you go on and do an additional economics course throughout your academic study. So as I said, costs are the same, regardless of what type of industry we're talking about. And these chapters become extremely important that you understand one to understand the rest. So I know I'm going to be doing a fair amount of writing on the slides. Bear with me. I have a new device that I have purchased to try and get my points across clearly. If you ever have any questions, please don't hesitate to contact me. And without further ado, let's go ahead and get to chapter 13. So let me share my screen with you. Okay. So in chapter 13, the first objective that we're going to look at are what are included in a firm's cost of production. This is actually an overview, this very first portion, and we're going to talk about lots of different things in here. Okay, so the first thing I wanted to do was to show you some important types of information that we will be looking at. And if I were to write on the board, this would be what you would see. So the first thing that we want to be able to recognize is that profit is equal to pi in business, okay? And for a business, profit is equal to our total revenues, which we've studied as price times quantity. And that would be TR, okay, minus total cost, which would be TC, okay. Now we know, and we've studied, total revenue is equal to whatever our price is, or price, P, price times quantity. And in chapter 4, we studied the idea of we have a demand curve and we have a supply curve. Our price equilibrium is going to be right here, price equilibrium, and our quantity equilibrium is going to be right here, Q sub B. We have said that, let's see if I can do this, that our profitability is this area right here, this rectangle. Okay, now we've also looked at the idea of total cost, and we said total cost is related, I think is the best way to put it, to the supply curve. So if we have quantity and price, this is the supply curve, and it's made up of a bunch of producers. And remember that those producers that are toward the y-axis, let's see if I could do this. These producers right in here tend to have lower costs than these producers, which are farther upward on the supply curve. So just to kind of put it into context with what we've been talking about throughout the course, I wanted to make sure that you had this kind of general idea as we move into this first lecture. Essentially, we're going to leave revenue out of it for right now and just simply talk about these total costs. So you might be thinking of some total costs already, and the total costs that we've talked about, let's see, would be the costs of our factors of production. You're going to see that in the next slide. Okay. Okay, so without further ado, let's go ahead and get into the actual slide. All right, so here, if you don't know, this is the CEO of General Motors, followed by a snapshot of General Motors. So our first question is, let's say that you are the Chief Executive Officer of General Motors. Think about some different kinds of costs that you have. So many of you may be thinking already about the factors of production, and you might be thinking about the number one cost to most businesses, which is labor. And we can see that as demand slides, that labor will be decreased in terms of people being laid off or furloughed and so on. You might be thinking about the land, and that might be the buildings that General Motors owns. You also might be thinking of capital, and that capital would be the machinery. So here we have labor, we have the land, actual physical proximity down here, and here we have some capital. So when we think about all these costs, we want to take a look at them and kind of take a broader perspective of them and asks, basically, how are different decisions affected by these costs? And you're probably already thinking, well, how much am I going to produce? Is there a right amount to produce? And we're going to find out that there is. Also, at what price can you charge? And there are many other questions and decisions that are affected by our cost. So that's kind of the emphasis of this particular chapter. So in this chapter, this is actually an introduction to Objective 1, but we're going to take a look in the next objective is what is the production function? And this production function is a little bit different than the one that you've encountered perhaps in other economics courses or in Introduction to Business. Also, I'm sorry, let me back up. In our second objective, we're going to start to look at the word marginal. And remember, we learned some time ago that marginal means an incremental change. So we're very interested in this particular chapter, how do costs change as I move from a quantity of nothing to a quantity of 1 to a quantity of 2, and how do my costs change in between these? So that's where we get this idea of marginality. The third objective, we're going to look at some various types of cost, and this is where we kind of rely on our accounting backgrounds, and we're going to look at classification of cost. Okay. Then we're going to take a look at how costs differ, both in the short term and long term. And we'll see that it really deals with this kind of idea of called economies of scale. Okay, so that's kind of a big broad overview of what this particular unit looks at. Okay. All right, so we have total revenue, total cost, and profit, as I introduced in the very first slide. So we're going to first say that a firm's goal is to maximize profit. And essentially what this means is we are going to be, how do I want to put it? Sometimes if this is a goal of a firm, and we could say that a goal of every firm is to stay in business, but this is where ethics can be a little bit difficult because perhaps your costs might be lower if you become or if you're polluting. And you might say, well, I don't really want to increase my costs to have a greener environment. So therefore, in the way we're approaching this, which is one of the economic schools, that's bad. Is to maximize our profitability. This means that we want our total revenues to be the highest that they can possibly be while having our total costs be the lowest that they can possibly be. Okay? Now, just to put this again into context of what you've been looking at, the total revenue is that area that is below the price. Okay, let's do it this way. So the total revenue is going to be below the price, but above the supply curve. And again, just kind of looking at it again, if we have a demand curve here and a supply curve here, this is our price equilibrium. Here's our quantity equilibrium. And if we want, geez Louise, didn't mean for that to happen. And if we want to look at the profitability, we want to look at, we're looking at this area right here. There's our total revenue. Our total cost we've looked at before, and we're going to say that our total cost really looks at the supply curve. So if you remember again, supply curve, we said here's a quantity, here's the price, and we have a bunch of suppliers in this market. These individuals down here have a much lower cost than these individuals up here. Okay. All right. So let's talk about a little bit between how an economist and how an accountant views cost. So cost can be either explicit or implicit. An explicit cost has a dollar amount attached to it. You can easily quantify it, okay? So it's quantifiable. Okay, so they're costs that you would get on a report, perhaps an income statement, and you're really able to know those very easily. This is what the accountant deals with, are these explicit costs. As you know, that the economist deals a lot with the idea of economic or opportunity cost. I'll abbreviate that from now on as OC, opportunity cost. So this is where accounting and economists really part ways. What we're going to say is, for an economist, we're going to look at everything. Economists look at all costs. That's kind of important. Whereas our accounting partners only look at explicit cost. Okay, so here's an example of explicit and implicit cost. Let's say that you need $100,000 to start your business and the interest rate is 5%. Well, in the first case, we're going to borrow $100,000. So we want to ask ourselves, what's the cost of that? And because we're borrowing the money, there is only an explicit cost. The opportunity cost is simply not borrowing the money. So the explicit cost would be the $100,000 times the 5%, or $5,000 is the explicit cost to doing this. There is no opportunity cost because it's borrowed money. But now let's take a look at a different scenario. And in case 2, we have some money to start this business. So what we're going to say is our explicit cost is going to be the $60,000 that we're going to borrow times the 5%, which is going to be $3,000. Okay. Our implicit cost is, what else could you do instead of using the $40,000 of your savings? You could leave it in your savings and earn 5% or $2,000. So if we add these two together, our costs become $5,000 as it was above. Notice just a different way of how economists and accounting individuals view costs. Now, one thing that's important is, again, because accountants only look at explicit costs, they're going to be able to actually calculate a profit or perhaps a loss if we're not doing so well at that particular time. Economists, however, because we look at all costs, and this is the point that sometimes in later economic courses becomes difficult to measure, is economic profit will always be equal to zero, because we're also looking at all of the opportunity costs or implicit costs that we could be doing with that money. So just something to kind of note. The other portion that I think is probably important, particularly for the test, is to remember that if you do have a profitability situation, accounting is always going to give you a higher amount of profit. Whereas an economist would simply say the profitability equals zero. Okay, let's take a look at another example. The equilibrium rent on office space has just increased by $500 a month. Compare the effects on accounting profit and economic profit if you rent your office space. Okay, so if you rent your office space, then basically your explicit cost, how much you're paying for your office space, is going to increase by $500 per month. Do you have any implicit cost? Well, not really, because you don't own it, okay? So in the first scenario, both accounting profit is going to decrease by $500 a month because it's a cost, it's something you're paying. And the economic profit is also going to decrease by $500 per month. However, if you own your office space, now we've got some opportunity cost here. So if you own the office space, now you might be thinking to yourself, can I rent this out? And I'll work from home. Okay, so now we would say, okay, if you own the office space, that might be your opportunity cost. So your economic profit would actually be the loss of the $500 per month. I think it makes it clear in the next slide. Okay, explicit costs don't change, but your opportunity costs of owning it, so your economic cost falls by $500 a month. And essentially, if you say, well, the explicit costs don't change, but notice the implicit costs here do change because you could rent it out. Okay, that's the end of our objective